All right. A very good day to everyone who has logged in and joined us for this webinar. Apologies for a short delay. We've been fixing some dial-in issues and some connectivity issues, but we're good to go. My name is Eveline from GOGLA, and I will moderate this session, which is organized together with Solarplaza in preparation of our also jointly organized conference, Unlocking Solar Capital Africa, taking place on the 7th and 8th of November in Kigali. The agenda of today looks quite simple. I'll give a very short introduction, after which we'll quickly move on to the main body of the webinar with our three panelists, hopefully three. We have two for now, but we'll aim for three. And afterwards, there will be time for a Q&A. So this time will be, it will be the third time that we organize this successful investor conference. We've held it the first edition in Nairobi. The second one was in Abidjan last year. And this year we return to East Africa and land in Kigali. So we expect to have or attract well above 350 participants. We have already started working behind the scenes to deliver another excellent event. And so in this event, we cover the full solar electrification spectrum, from on-grid topics to off-grid to mini-grids. Solarplaza will be coordinating the on-grid part of the program, and GOGLA will take care of the off-grid content. And as always, we'll put a large emphasis on networking and matchmaking. I'm happy to let you know that we are joined by FMO as an organizing partner, and that we also already have the support of the first set of sponsors, one of which is TCX. So this is basically the first of a series of webinars that are leading up to this conference, and we'll be focusing today on how businesses and financiers are working towards eliminating, or maybe rather managing, currency risks in the African off-grid solar sector. So before I introduce our speakers, I have some useful practical notes. We will share the recordings and the presentation slides afterwards. If you have questions for the Q&A, you can use the chat box. If you have a specific question for one of the panelists, please also type their name. We will collect the questions and add them afterwards. If you have technical issues, you can also let us know via the chat box, and we can see if we can do anything about it. Yeah, I think I won't let you wait any longer. I'll briefly introduce our speakers. Per van Swaay is the Senior Vice President Structuring at TCX Fund. He's responsible for TCX business development in Africa. I'll let him explain at the end what TCX specifically is, but it's a special purpose fund to hedge currency and interest rate mismatch in investments between investors and borrowers in frontier and less liquid emerging markets. Then we have Avi, who is our Senior Investment Officer at SunFunder, who are amongst the first to provide commercial debt financing to the rapidly growing energy access sector. He is responsible for managing relationships with SunFunder's clients and optimizing their debt structure. The person that we are currently waiting for is Greta. So Greta, she agreed to take Sudeep's place, who was initially scheduled to be on this webinar, but had to cancel due to a conflict. She's an investment analyst at BBox, and if she manages to join us online, she will be excellently placed to share BBox's experiences with local currency dealings from the angle of a solar home system designer manufacturer. But I will, for now, we will skip her presentation and we will go to Avi, and Avi will be the first to take stage. Avi, the floor is yours.
All right. Thank you, Eveline. Hello, everybody. I'm Avi Jacobson, a Senior Investment Officer with SunFunder, and I'll be starting off talking about how a lender or a financier thinks about eliminating currency risk, specifically in the African off-grid solar sector. I'm not sure I have control over my slides right now. Good. Thank you. So what I'll be talking about today is a little bit who SunFunder is, who we serve, the type of products that our loan products are, and that will, I think, provide some context for the type of currency risk we're exposed to, how we manage it, and some hedging and currency risk managing approaches that we think are smart, or that we are using at the moment. Next slide, please. Back one, please. So a little bit who we are, what we do. So we're a solar finance business looking to unlock capital. So we're trying to be a commercial lender, providing for the debt needs of companies that are providing solar energy services, primarily in the off-grid sector and focused mostly in sub-Saharan African markets. So here, roughly over $55 million of investor funds unlocked into the sector, over 3 million people impacted in 12 countries. I think that number has since increased, with less than 1% default rate. We go to the next slide. It's a little sort of example of some of our customers. A lot of this is publicly available information, but the important thing to note here is sort of across a wide variety of sort of subsectors, whether it's the home systems offering on a pay-as-you-go basis, distributors and suppliers, and even looking into commercial industrial opportunities, both sometimes on grid, off grid, and some of that in between diesel or backup replacement opportunities as well. Go into next slide, please. A rough overview of the types of loans we offer. Some of this does align specifically with the size of the solar installation, and some of it just more in general, different ways. And part of it is, we see our role of being creative solution providers to the sector. So for some of the smaller, more straight lantern distribution opportunities, looking more sort of inventory and working capital loans, meaning covering the gap between when they need to place an order from their supplier to when they actually earn the revenue through sales. When we're working with solar home system providers, you can manage that sort of gap between when they have to order a product and actually receive the money back from the customers over a 1 to 3 year contract period. Requires financing, and it's sort of ideally fitted to debt financing, and that's where we come in. So we work on a variety of ways, whether it's on balance sheet loans to the customers directly. That can be more structured products, as we sort of publicized our SAFI product, where we lend to an SPV that holds the receivables, and so we're lending specifically against the customer contracts. And as we get into working with commercial industrial developers and EPCs, it's construction finance, sometimes working capital against pipeline, and getting into some more traditional project finance opportunities as well. Next slide, please. So the question that comes up now is currency risk. We start talking about 1 to 3 year, or even sort of minimum 6 month up to 3 year plus loans. Currency risk is an issue because, as we see here, we generally lend in US dollars. We raise our funds in US dollars, but most of our customers are earning the revenue in local currencies when they sell. Borrowers to repay us essentially have to take their local revenue from local currency and somehow source US dollars or maintain a US dollar reserve in order to repay the debt. We think of that, the risk of default due to exchange rate is shared. We will do our underwriting, we'll see can they earn the ability to pay, and with that's going to become certain assumptions about what that revenue means in US dollars and ability to pay. However, absent some type of mitigating strategy, if they're not earning enough in local currency to source the dollars they need, they default, and if they default, we don't get paid. And that's not good for any of us. So when I say it's a shared risk, it's very much the downside of that affects us both. Longer loan tenors, especially, I'm not done yet, I'm sorry. Back one. So going through the idea of the longer loan tenors, if we sort of over time, historically, maybe looking at inflation rates or appreciation of local currency against the dollar, the longer the tenor of the loan, the longer that sort of average dynamic may impact it and affect and expose to that. However, the long-term average doesn't necessarily mean what's going to happen during your loan period or even during the next week. I picked here just a slide the Nigerian Naira, in part because of my earlier operating experience within the solar home sector was focused on the Nigeria market. And also, I think it covers some just sudden shocks that can be hard to predict in this 5-year chart, where some changes in policy led to rapid shifts in the value of the Naira. I distinctly remember one day when it essentially dropped by almost 50% when the government abandoned the 200 Naira to the dollar peg. And some of that can be predictable, some of it's against the long-term average, but if we were to make an average, you'd imagine sort of a steady line that would take you from closer to 100 up to the 360 trading point now. Instead here you see some minor volatility and then sudden rapid changes. And that's hard to model. So if we go next slide, please. How do we assess that and how do we deal with that? So when thinking about currency risk in general, this is our approach. I don't think there's anything incredibly innovative or novel. We're not the only ones facing this, nor are we the first to confront this issue. So we think about what's driving currency risk in a given market. Some of it is going to be larger term macroeconomic factors, whether it's if we're a dollar fund, a lot of the price of the dollar is going to be set by the US Federal Reserve and their rates, and how they shift is going to change expectations of the value of the dollar relative to other currencies. Local economic factors, whether it's a recession, rapid growth, changes in exports, lots of different things that may cause demand for that currency to change. And then political instability questions. Sometimes there are somewhat regular shifts in currency value around election times and the like. So understanding that and trying to get your head around what's going to drive those risks. Is there a currency peg? This is another one where parts of our target markets, there are, we were to take, say, the CFA franc region, for example, there's very, very firm peg of the value of the franc against the euro. It's been solid, steady, very little expectation of there being any shift. But we saw on the slide before, sometimes, say, if there's a peg against the dollar, for example, one day the change in government policy can cause a major shift. We saw that in Nigeria a few years ago. We're still seeing some little bit of that effect. We're seeing that in Egypt recently as well. So the question there becomes, as an indicator, is there a spread, if any, between official exchange rates at that pegged amount and black market rates? Because if there is some type of spread, then that usually indicates that there's pressure, might be pressure to change it, or it could be difficulty sourcing dollars for our client if there is this strong black market demand demanding a premium for dollars. Other things than just doing the basic underwriting as you model is understanding what exchange rates can the loan sustain. So if there is a decrease in the value of the local currency which they're earning revenue, at what value to the dollar does the loan start being stressed? Other pieces to look at then are there reputable forecasts. There are a variety of indices that do reporting and set forecast goals for on currencies and exchange rates. It maybe as a former weather forecaster, I'm very sensitive to issues and uncertainty around long-term forecasts, and I don't think currency forecasters are anywhere better or even near as accurate as your local weatherman. But within that, that gives you a sense of the range you can expect and just an index to test against when looking at exchange rate risks. And then understanding the issue of exchange rate risk versus convertibility risk. As I mentioned before, exchange rate risk just says what the rate one currency can demand against the dollar. Convertibility is the issue of can you source dollars in this example in the local economy? We've seen areas where, as I mentioned, if there's a sort of a great black market premium rate against the official rates, exchange rates, then that means people are competing to get limited dollars. And so your client, if you're a lender, may not be able to source the dollars they need. So understanding and looking at that. Or there could be policy changes or capital controls implemented as well. But that's different than exchange rate risk. So understanding the difference and which piece you're mitigating. Next slide, please. So mitigating and managing the currency risk. How do you take your loan and I just like this image of protect it the best you can? The simplest and bluntest instrument is just having a cash reserve against currency risk. So having the company required to hold a certain amount of cash so that there's a buffer that exists. If the currency value goes down, there's extra cash available. Depending on the type of loan and client, in some cases we've had clients who have somewhat of a natural hedge where their local currency costs are offset by their local currency revenues, and a lot of their other transactions are denominated in dollars. So it mitigates their actual local currency exposure. There are opportunities we're looking at, or that larger lenders or government institutions have, to partner with local banks that can lend in local currencies. Often you're dealing with some very large institutions when doing that. So both as a borrower, you should be aware, and also as a boutique lender such as SunFunder, being aware that those can be complex and expensive transactions. Complexity will make it slower on top of all that. And then the other piece is usually you need some type of outside development institution or multilateral or government support to push a local bank into this, because to date, local banks have been more reluctant to lend to energy access companies. That's sort of a side conversation on some of the dynamics as to why, but it is just something to be aware of. So they are the ones most able to lend in local currencies and work on managing that, but they're also, unfortunately, the least active. The other piece that comes in then is hedging, which is working with a third party such as TCX to set essentially predictable exchange rates. You have a hedge in place, and you're going to have a set schedule for what the currency exchange rate will be, or what price you'll pay for that currency at a future date. So it gives you predictability, but you have to pay for that predictability. One thing as both a lender and borrower to be aware of with hedges is they have a fixed schedule. And what that means, if we're setting up a loan, for example, is that on certain repayment dates, we'll have a hedge in place that says on that date, the exchange rate will be X. And so we know what the conversion will be. But if for whatever administrative reasons, the payment coming from our client is late or delayed, it can happen, things get hung up at banks, whatever else. If we're the one who've taken out the hedge, we are still on the hook for settling with our hedging partner on those dates. Additionally, say that the client wants to prepay or is paying early or something along those lines, or for whatever reason, we want to alter the schedule of the hedge. A hedge, when you put in, there's a trade-in with set schedule and timing, so breaking that is going to have costs. So how those costs are borne is something that must be considered and planned for. As mentioned at the outset, one of the incredible services that TCX and we work with MFX offer is hedging solutions in markets where there's not a lot of liquidity. I think Per will get more into detail about what that means, but it also means there's not necessarily a lot of negotiating room and discussion. So in some ways, it's a unique product. It's incredibly useful to have access to hedging tools against many of these currencies, but it's going to come at a cost, and it just makes sure everybody's aware. I think generally they're reasonable, but it's just something to be aware of. And the other piece is hedging, and especially non-deliverable swaps, which I think will be addressed later. We can address the differences in the question period. Does not necessarily address convertibility risks. So if you can't source dollars locally, or you can't export them, then you have issues with your loan that are entirely separate from whether or not you have sufficient funds to pay at current exchange rates. So it's being aware that there's a distinct risk in there, separate from just exchange rate risk on its own. Next slide, please. So I think if I'm going to put in conclusions on how SunFunder approaches this, is one, currency risk is something that can be managed, but not entirely eliminated. Like any other risk, understand it, understand what's driving it to the best of your ability, and put in a mitigation strategy. The best approach is going to be situation dependent based on in your market and with the loan that you're contemplating and with the client you're working with. What are the risks that come up with their business in that market? So the best approach is going to be situation dependent. And then, as always, just because SunFunder may have a certain preferred solution or the borrower may have a preferred solution, how currency risk is managed is ultimately subject to negotiation between lenders and borrowers. So we may have our sense of these best approaches and these list of things, but the exact mix is going to come down to a variety of factors. I can't say that there's a set formula. With that, I think I'll let the other presenters take on, and then we'll come back to it on questions.
All right, thanks very much, Avi, for sharing the views and experience of SunFunder with local currency and how you're managing the risk, as well as what you do with regards to hedging that risk. For the audience, I would like to remind you to keep asking your questions in the chat box on the right-hand side. We've already had some few questions, and so we'll be collecting them, and then we'll be addressing them at the end of the session. So for now, we are still lacking one panelist. We are trying to get her online. So we might even have plenty of time for the Q&A. So do ask those questions. And in the meantime, I would already like to give the floor to Per van Swaay, who is with TCX and hopefully there to take over the presentation. Per, are you there?
I am here. I need to ask you if you can hear me well.
Yes, we can.
Okay, because for you, well, but the audience, I am in Zambia, so there's always the risk of weak connections. But unless you tell me that I'm not being heard properly, I'll just continue. Thanks a lot, you, Eveline, for hosting us and presenting, and Avi for your view on the topic as a lender. I hope that the audience is sort of relatively new to the story and what we have to say, because we have done this a couple of times before, and we do regularly speak about this topic at events. So we hope you're not yet suffering from local currency or fatigue. And on that assumption, we'll just repeat ourselves a little bit here. So on the next slide, Eveline is managing those for me, so I have to say that every time. We'll just flick through some general comments on TCX for those who are not that familiar with what we are and what we do. We have been around for 10 years. These are our shareholders and also our main clients. We are very much a DFI ourselves. Our role is to help all the international lenders, DFIs, impact lenders, lend in local currency. So we work with these lenders, but through one of our partners, MFX, through a much larger group of lenders. So basically, you could say that most impact lenders have access directly or indirectly to TCX and therefore can lend, such as SunFunder, who works with us through MFX, and therefore all these lenders can lend in local currency, be it a synthetic loan. We'll explain. The next slide, Eveline will probably show our global diversification. No, we have one product. And this is actually quite relevant. This is, this is the structure that we typically support, and that is relevant to many borrowers. So if just to walk through it, it immediately addresses a couple of the technical topics that are important, and some of which Avi already touched on. So imagine that here the onshore borrower is onshore, meaning in the country of relevance, so where you are operating. That could be any African country, of course. So that's the off-grid company. Let's say that the lender offshore is SunFunder, and that the client they have requested for a local currency loan. Lender and borrower have agreed that the loan will be a local currency loan. SunFunder can provide a local currency loan because it can then transfer the exchange rate risk to us. If you flick to the next slide and back, Eveline, you'll see, I believe, yes, that's right. Just to make the point that between SunFunder and us, you have an institution called MFX Solutions. We can go back to the previous slide. And if you are looking at local currency loans, you will always hear, at least in these markets, two names mentioned, TCX and MFX. MFX is an intermediary between us and many of the lenders, as you just saw in that image, and that's also the case with SunFunder. TCX is the body, the institution that takes the currency risk. MFX sits in between us and lenders to eliminate collateral terms, to make the transaction much more simple and attractive for lenders and therefore for borrowers. That's the relationship between the two. So back to this structure. No, back to, to the original, this one. Yeah, sorry. Just to describe how the local currency loan works. Obviously, we're talking about an offshore, offshore being not in, let's say, Uganda or Kenya, but in Europe or the US or wherever that lender sits. How does a lender that sits in Europe lend in Kenyan shillings or Ghanaian cedi? Well, it doesn't lend by providing those units of currency literally. Rather, what it does, it provides a loan which is indexed to the shilling or the cedi or whatever. You can index a loan to anything, whether it's another currency or any other benchmark, the price of soya beans. It doesn't matter. In this case, what the lender does, it provides a loan in dollars to the borrower, but parties index the loan to the local currency, which means that if there are movements in the local currency, that will then impact the amount of interest and the amount of principal repayments that must be serviced. So how does it work in practice? Let's say this is a $1 million loan that the borrower needs. What will happen is that at disbursement, I'm going to use SunFunder here. SunFunder would disburse $1 million to a bank account designated by that borrower. That might very well be a bank account out of Africa, because the dollars that will be disbursed into that loan, into that account, might be typically used to purchase solar panels, for example, in China. So the borrower receives $1 million wherever it wants to receive those. And let's say that in this currency, the exchange rate at disbursement is 10 to the dollar. What that does is that when there's a hedge which is executed, one of the things that happens is that the local currency notional amount, the local currency repayment obligation, so the notional amount in local currency terms, is fixed using that exchange rate. So the loan is $1 million, exchange rate 10. Therefore, the local currency notional of that loan is now $10 million. So the borrower has now received a $10 million local currency loan. It's for the borrower, it's a local currency liability. For the lender, it's a local currency asset. And the loan will also carry a local currency interest rate. The fact that it is disbursed in dollars does not alter that. At the time that the disbursement is made, SunFunder will immediately execute via MFX, but that doesn't really matter, will immediately at the same time execute the hedge. The way to see the hedge or a swap is the product that we use is literally what it is. See it as the exchange of two loans. The proper way to imagine this is that it is as if SunFunder in the end wants to have a dollar asset. And what happens on paper, the way to visualize this is that SunFunder gives the dollar loan, the $1 million loan to us, and it requires that we will pay to it the dollar interest rate on that loan plus the dollar credit margin on that loan. And we in return give a local currency loan to SunFunder. The exchange rate is 10, so that will be a 10 million unit local currency loan. And we also say to SunFunder, this is the local currency interest rate that comes with that loan. So that is, we determine, and you can explain and you can discuss about this for days and weeks on end, but we determine that interest rate, and how we do it, that's as I say, that's a whole discussion in itself. SunFunder then transfers that loan onwards to the borrower. So we provide a local currency loan to SunFunder. SunFunder provides a local currency loan to the borrower. And that's the way to see it. Now, if Let's say it's a bullet loan, and 3 years from now, the borrower has to repay that loan. Its repayment obligation is 10 million local currency, not more, not less. And that's the amount that it pays. However, it has to service it in dollars. If the exchange rate, for example, has now depreciated from 10 to 20 to the dollar, that exchange rate is used to determine the number of dollars that the borrower has to send back. So this will be $500,000. Obviously, that's evident that the currency risk over that period of time is borne by the lender. It has only received $500,000. It will only receive $500,000 from the borrower. However, because the swap will also mature, we will repay that virtual $1 million loan that we received from the lender. That's $1 million we owe to SunFunder, and SunFunder must repay to us the 10 million local currency loan it received from us, which now is only worth 500,000. They owe us 500,000, we owe them $1 million. We only pay the net difference, which is 500,000. So in this situation, SunFunder would receive $500,000 from the borrower and $500,000 from TCX. So we are the party taking the risk of the currency moving from 10 to 20. Avi mentioned a couple of times convertibility risk and transfer risk. That's a very important concept, and is also evident from this example. We support this structure, and this is virtually all local currency loans work like this. They must be serviced with dollars. So the borrower will, even if the currency depreciates by 500%, it will still need some dollars to service that loan. So whilst the loan effectively covers currency risk, the risk of depreciation over the life of the loan, it does not take away the convertibility risk, because the borrower will need to find or have access to a number of dollars to make its payments. Having said that, that of course is precisely the same problem with a dollar loan. So the convertibility risk is not unique to a local currency loan. That applies to any loan that is, well, also to dollar loans. So it's not a local currency specific problem. Yes, well, that is important. If you understand this, then we're doing fine. Can we move on? We can skip this. In the next slide, we can also skip this. It's just to show that we are a globally diversified business, which is the key core risk mitigant of TCX. This is an interesting slide showing that our role, as was shown in the in that example, we earn on that swap. We earn the local currency interest rate that the lender pays to us, and we pay back the dollar interest rate. So our revenue model is we earn the interest rate differential, and we compensate the counterparty for loss in the currency. On average, over billions of dollars of deals, thousands of transactions in many currencies, on average, we make a 1 or 2% spread. Bear that in mind when you think about hedging being expensive. On average, on a portfolio basis, the premium for taking zero risk is on average 1 or 2%, which is of course negligible. Moving on. So I've taken way more time than I was supposed to, but we lost the speaker. This is what we do. TCX absorbs the volatility in currencies so that borrowers do not have to bear it. And it's evident in our P&L. If there's a crisis, we suffer big losses. The next slide, please. So let's just assume a standard situation of an off-grid company that buys equipment in China and is now looking for the first time at debt. And it's thinking, should I take dollars or should I take local currency? There's a couple of things that I want to communicate. We'll rush through them very quickly. Number one, on the next slide, there's a few key points to bear in mind. the first thing that you must impress on yourself is that the currency of your debt funding, the currency of your liabilities, should be determined by the currency of your revenues, and in principle by nothing else. So the fact that you need dollars to buy equipment does not mean that you borrow in dollars. No, that's if you need dollars, maybe you buy dollars, or as we showed in the example, most local currency loans, the lenders will actually already give you dollars. So that is that does not determine the currency of your debt. The currency of your debt is determined in principle by the currency of your revenues, so that you're matched in the long term. Key message number one. Next key message, that's right, is as a business, you should not focus only, and you shouldn't, maybe not even in the first place, on price. People are always thinking about price, and we'll also tell you, as I just did, that there isn't really that much price difference. There's a lot of misperception around that. But the key thing is not so much the price, but about, it's about volatility versus stability. And if you look at the next slide, I'll try to show that with an image. If you, as a business, earning local currency revenues from your mini grid or solar home system provider, you have to click them through, Eveline. It's an animated thing. If you take out a dollar loan in Uganda or Tanzania, this might be the profile, that red stuff, one of 1,000 potential profiles of your debt service profile in local currency terms. You have no way of knowing what your actual debt service cost is going to be, because yes, you know that the cost of the dollar loan is 6%, but every year there will be an additional cost, being the depreciation of the currency. And not only the actual loss, but also the constant fluctuations in value. You have no idea what to expect. Whilst if you borrow in local currency, if you click on, you will see, I think, a nice steady green line appearing. That's because if you borrow in local currency, you know precisely over the term of the loan what your local currency cost is going to be and what the debt service cost is going to be. And if you click one more, of course, price of the hedge is important, but that just means is that nice horizontal line at what level is it precisely? Yes, it's important, but it's not the key thing. The key thing is stability versus instability and unpredictability. On the next key message, and we're nearly there, is that this issue of cost. Avi made a very, very relevant point that the longer the tenor, it's as I said earlier, on a portfolio basis, if you have a very large pool of deals, on average, the higher interest that you pay for a local currency loan is barely more, is our empirical evidence, 1 or 2% potentially, than the dollar loan plus the depreciation cost. In the next image, that is, we reinforce that point. If you take out, and you have to flick through it again because it's animated. If you take out a local currency loan, yes, in principle, the nominal interest rate will be higher than the dollar loan. But on the dollar loan, you must immediately add the expected annual depreciation in that currency. So you have to have a realistic assumption on what the currency might do. If it's a pegged currency, there's a whole different risk. But if it's an unpegged currency, like all the shilling currencies and the Cedi, Kwacha, etc., at the moment that you take out the dollar loan, immediately add into your projections an average annual cost, which you don't really know what's going to be. On average, the point is, over a longer period of time, over many transactions, those are similar. Whilst if you take the local currency loan, you have all the benefits of it. That is not to say that an individual business and an individual CEO, CFO who's looking at the difference between a local currency loan and a dollar loan of 15%, of course, he is tempted to speculate. But this theory is true in practice. Bear that in mind. Next and final message is that, well, this is actually, well, may I see that again? For the non-believers, what this shows, and it's a random sample, but this shows that over the period from 1 September 2014 to 1 September 2017, the green column is what the 3-year hedge rate was precisely at the beginning of that period, so more than 3 years ago. So, and the orange column is how what the currency actually depreciated per annum on average. So if you look at Ghana, the second one, GHS, 3 years ago, you could hedge at a cost of 21%. In actual fact, the currency only depreciated by 12%. So in hindsight, you could say I lost money by hedging. But if you look at the Mozambican Metikai, the Nigerian Naira, it's completely the other way around. So hedging would have saved you lots of losses. And in many other currencies, it is sort of similar, which only fuels the message you should always hedge if you believe in these numbers. Okay. And the final message is that we started with at the beginning. Local currency can be sourced from foreign institutions. If you are convinced that you should borrow in local currency to minimize your risk, to have stable customer prices, to not be exposed to shock risk, and to know what next year's budget is going to look like, then of course you can borrow locally from banks. Great if you can. But if that's not the case, you can borrow in local currency from the wider development finance community. They can all lend to you in local currency. So those were that's my story and a couple of the key messages, and very happy to address any questions.
All right, thanks, Per. We actually do have our second panelist, Greta, with us now. So I'm going to quickly move on to her presentation. Greta, we are a little bit squeezed for time, so I'm very sorry to have to ask you to keep it brief. But yeah, please, the floor is yours.
No worries. So apologies for arriving slightly late here, but I'm glad to join everyone. So basically, I'm an investment analyst with BBox. I've been here for 2 years, and essentially we're an off-grid solar company. So we're expanding rapidly throughout East Africa and more in the future into West Africa. So basically today, from more of the industry side, what I want to cover is firstly an overview of what we do as business. Many of you may be familiar with the off-grid sector. If you're not, I'm going to give you a brief overview of how our business model works. And then focus on, I suppose, 3 key deals that we've closed in the last 2 years. And to run through, I suppose, what the structure of those were, what our hedging strategy was, and why we took that strategy. So I completely acknowledge I'll have to keep it brief, but I will try and leave some time for a few questions at the end, if they exist. All right. So BBox was founded in 2010. We are essentially a utility company at heart, but that's driven by technology that's designed and created from our global headquarters in London. Our East Africa headquarters is based out of Kigali in Rwanda, and that was our first market that we entered. We have a fully vertically integrated supply chain from the design and both the hardware and the software engineering design based in London, to the manufacturing in China, to the distribution network that we have across East Africa. We've distributed now over 150,000 solar home systems, and I suppose when I joined 2 years ago, and over that period, I've seen a rapid scale up of our portfolio. So I suppose commercially, we've been operating aggressively for kind of 3 or 4 years. But the last 2 years, there's been a real focus on doubling down on our existing markets and equally expanding geographically. So we call our business basically a distributed energy services company. So if I'm referring to DESCOs as we go through, that's what I mean. I mean, a DESCO is our Rwanda operations, it's our Kenya operations, it's our DRC operations, and that's just how we refer to the utility company that we've become. So off-grid solar, as many of you probably know, it's a self-contained solar home system that is given out to customers, and then they pay it back like we may pay off a mobile phone contract over a certain period of time. So BBox, this is the 3-year contract, so they pay off their appliances such as lights, televisions, radios, torches over a 36-month period. A slight difference in our business model comparatively to our competitors is that we believe strongly in energy as a service, okay? So we want to have an existing relationship with our customers in the long term. So they pay off the control unit, so that's the battery essentially, and a PCB that sits in there that allows us to remotely connect to the unit, and the panel over the course of 10 years. Why the long contract? And that's a big educational hurdle that we have with our customers. Basically, we want to keep that relationship in the long term. We don't want stranded technology and assets out in the field across these developing countries, and we think that relationship with the customer is incredibly important in the long term. So they pay that off over 10 years, but we provide all the maintenance support, both technical and customer support over that period. So I think that's a good thing about the off-grid sector is there are slightly differing business models, and they cater to slightly different groups and different customer needs. So I think that's a really positive, I suppose, development across the sector, that people have, in some respects, individualized their business models. Okay, so I'll just touch very briefly on kind of our supply chain here. So as I was saying, we own all the design of our products. We manufacture them in our entity in China. We then transport them to our distribution center, where they are then tested for quality purposes, and then they're distributed to our shop network. Through sales agents on the ground, we then sign up customers who get their systems activated. So currently we're in Rwanda and Kenya. Those are our kind of core markets. In the last year, we've expanded into Democratic Republic of the Congo and also in Togo. And we're looking to expand up into West Africa in the coming 12 months. So it's a really interesting time to be part of the company, and basically what we're trying to do is leverage that experience that we've built up in Kenya and Rwanda, both from an operational but also equally from a financing perspective, which is what I will get into, and leverage that experience and apply it to different markets. There's obviously a few barriers to entry in creating a solar home system company in different markets. So the first is kind of the technology side of things. Well, we've kind of got over that hurdle. We've been operating now since 2010. We've got a very strong software platform, hardware. So we've conquered that hurdle. The second one is financing, and that's what I'll get into in more detail here. Our customer contracts are long-term. Our industry is incredibly capital intensive. Obviously, we have to pay for all the units up front. And finally, managing our customer, so managing our portfolio. That's not so relevant today, but naturally it feeds into our ability to pay back loans and the financing side of things. But today I'm going to talk about kind of three, I don't actually have any more slides, so it's going to be just my voice after this. But I'm going to talk about three key financing options that we've considered over the last 2 years. First, in addition to this, we have done a small securitization, but I'm not going to focus on that today. I'm going to focus on more loan types that we've brought on into our entity. So firstly, which is what has been touched on already, local currency debt is incredibly important to our business. And this is we mainly get it from commercial banks, both local and foreign. The second one is hard currency, which we have raised through crowdfunding platform Trying. That's an interesting case, and there are a few aspects of that deal that made it more attractive, because obviously there's limitations of taking on loans in hard currency. And finally, hard currency loans from the likes of impact funds. Okay, so I'll start with A, in local currency from commercial banks. In February 2017, we closed a local currency deal with BPR, which is a local bank in Rwanda. Okay, about 6 months later, we closed a second deal in Rwanda with Deutsche Bank to the value of 5 million. The BPR deal was to the value of 2 million. Now that required an intercreditor agreement between the two institutions, which was the first of its type in this sector. So from a hedging perspective, we are fully hedged on the Deutsche Bank deal. The Rwandan franc is obviously quite volatile comparatively to other currencies that we operate, such as the Kenyan shilling or the Central African franc. So for that reason, we made the decision to use MFX as the intermediary and basically ensure that we're fully hedged. That was, so as I said, that was a 5 million deal for Deutsche Bank, and that is split across two drawdowns of 3 million and 2 million. Now, we'll compare that then to we'll jump to C here, which is the hard currency funding that we received from SEMA Fund. Now, this wasn't fully hedged. The decision was made on this purely because the Kenyan shilling, the variance of that, isn't as great as the Rwandan franc. So basically, we have hedged here the principal of the loan, but the repayments aren't hedged due to the quarterly variance basically not being significant enough to justify the cost of the hedge. So that's kind of a strategic decision that we made internally in the finance team. And obviously we review that month on month to kind of understand whether we want to enter into forward contracts to reduce that risk going forward. So SEMA here takes the risk on of the cost of the hedge due to us hedging the principal of the loan. And we pay the cost of the hedge in quarterly installments. It gets lower, obviously, as we pay back the principal over time. The final, I'm very conscious that I've got about 3 minutes left here, but the final area that we look at in terms of from a fundraising perspective is raising loans in hard currency from the crowdfunding platforms. This is very attractive due to the flexible nature of the transaction. It's an unsecured loan. We draw it down at the parent level, and then we can on-lend that to our entities as required. We bear the risk of the Kenyan shilling movement, but at the moment, we don't think, this was a euro loan, but we don't think the shifts are enough to justify the cost of a full hedge. But we do review this on a monthly basis. And if that changes, then obviously we will change the strategy on the hedging side. The other markets that we have facilities in is in the DRC. Obviously, in the DRC, we're paid in US dollars, so it's fine there. In Togo, the Central African franc is pegged loosely to the euro. So therefore, we draw down our loans in Togo in euros, and that creates, I suppose, no need, obviously, for a hedge there. Just to reiterate, one of the key considerations that we have whenever we're looking to draw down any facilities is ideally we do want them in local currency. So getting those first local currency deals across the line were very challenging for our business. But going forward now, once the precedent's been set via the likes of the BPR deal, the Deutsche Bank deal, we're finding it a lot easier to raise local currency debt. And that's one of the important things, I suppose, of anyone operating in an industry like that. Getting those first transactions across the line is essentially the biggest hurdle. Once you have that precedent, it makes it a lot easier to understand, I suppose, lenders' appetite for risk and negotiate specific, more favourable terms, I suppose, that work depending on your business model. For us, the terms such as grace periods, for the grace periods on principal repayments are incredibly important due to the manufacturing cycle that we go through and then the distribution out to the customer. So I suppose in conclusion, I think we have taken numerous different strategies from a currency risk perspective over the last couple of years. It depends very much on the markets that you're operating in, and I think that's probably the biggest challenge there. It's not a one-size-fits-all in the strategy that we take, but I hope that gives a very brief overview of a few facilities that we've closed in the last couple of years, a very high-level overview of the hedging strategy that we took and the reasons behind whether we're fully hedged, partially hedged, or, for example, no hedge being required at all. So I'll open up the floor to questions if we've got a little bit of time for them.
Thanks, Greta. No, no worries at all. I mean, yes, officially we're at the end of the webinar, but I don't want to, because we've been receiving some good questions here, so I don't want to cut out our Q&A session. For everyone that needs to leave, you can check the recordings afterwards. We'll add the Q&A there, so you'll be able to listen back to it. I will still, however, ask our panelists to be concise in their answers, so that we can get as many questions addressed as possible. All right. So I think, Avi, we can kind of start by going back to you, and I have two questions that I think that I can combine. So there are, why are local banks reluctant to lend energy access companies and energy access companies, and what are potential solutions to change this? Maybe start there. It's a question from Elucian Eludoyin.
Sure. Thank you for the question about why local banks have been reluctant. I think part of it is understanding how banks, particularly in these regions, but it's not unique here, operate. Traditionally, some of them have a specific mandate to invest in a certain amount of government debt, so that takes up some of their capital. The other piece is, historically, they've been offering loans to established companies with more traditional forms of hard collateral, such as plants, factories, and by plants I mean hard generating power plants, for example, factories, land, hard assets that can be pledged and taken, or even personal guarantees. And for energy access companies in particular, they don't necessarily have that. Often they're dealing with contract manufacturers if they're more vertically integrated, or outside suppliers, so they don't own or control the factory. Their assets are really these distributed pieces of equipment that are all over with client homes. So it's not something that can be pledged the same way that these banks are used to. So it's an underwriting challenge. It's getting used to an entirely new way of doing things. There may even be regulatory hurdles to what they can accept as security in these situations to get them involved. On top of the fact that in some of these cases, these are rapidly growing businesses that may not be, say, cash flow positive or balance sheet profitable, even if they can definitely support debt as part of their growth. And the lack of profitability, if you will, is more due to just seizing an incredible growth opportunity with a market that's been underserved for so long. But banks don't necessarily understand how to underwrite that or manage that. So I think that's some of the biggest issues preventing local banks from getting off the sidelines. In terms of resolving it, some of it's been partnering with development institutions or the World Bank. World Bank in particular, say, using the SunRef program in Kenya, for example, is offering, that's actually not through the World Bank, that's through the French Development Bank. But examples where they work with a partner bank, they will offer maybe concessional rate money or offer them money that they can then on-lend to customers in the energy access sector. But this way, the bank doesn't necessarily feel like they're risking their own capital, but they have provided incentives now to invest or on-lend somebody else's money into the sector, and with that, gain experience. The other thing we're looking at is how do we partner with local banks so we can leverage our existing expertise and experience in the sector to get them comfortable, but have access to their local tools, expertise, access to currency, additional controls and tools.
All right. You're still there, right, Avi? So I think we might have lost him for a bit.
I'm sorry about that.
If he goes back, oh, you're there. Okay.
I'm here.
Okay. Just to think, another quick question, which is more related to your clients. What type of warranties are you requesting from your clients? And also, if you can share that, what is the total value of SunFunder's local currency loans today?
Unfortunately, I'm not sure I can get into the details, specifics of our portfolio and the total amount of local currency loan. I'm happy to say we're actually actively negotiating multiple deals that will also intended to be in local currencies, or at least in other currencies from where we lend. Because you can imagine we're dealing with these cross-border transactions. Sometimes there's local currency, sometimes there's a variety of what people collect in versus what they need to pay in. But as far as the warranty question, I'm not sure I fully understand as far as a product warranty. In some ways, Greta may better be able positioned to answer, but from our perspective, we want to see a warranty period that at a minimum covers the contract period that a customer may have with the company. So say if it's a 3-year contract to finance the purchase of an appliance that connects to the power unit or the power unit itself, the home system. If it's a 3-year repayment contract, then the warranty should at least cover that 3-year period.
All right. Per, I have a question from Wanjiku Kariuku. Can the borrower come directly to TCX for hedging? Or, one second, let me check. Or would you rather work with the financier?
No, in practice, we don't work with corporates directly because it has been proven to be quite complex. It imposes a lot of additional work also operationally on the borrowers who, very often are young startup companies. We don't have sophisticated finance treasury departments yet. And while, as I was trying to convey very simple concepts, the hedges tend to be quite complex when you look into the details of it. So and there's also collateral issues around that. So no, in practice we try avoiding working with corporates directly. And for the corporates here, for many of the off-grid companies, it's certainly at the early stage, because all of their revenues are in local currency. In principle, all of their debt should be or can be in local currency. So for many of them, it doesn't really matter because they might as well borrow everything in local currency. Having said that, as was clear from Greta's story, certainly the off-grid companies that are growing, operating in multiple jurisdictions with multiple different currencies, with maybe some kind of treasury function in the holding company, then things start to become very different, and they might have a more dynamic, a more sophisticated approach to hedging, and then it does make sense actually to think about having a direct relationship. We would still probably not do that for also internal restrictions, but MFX, one of the nice things about MFX is that under their guarantee mechanism with OPIC, they have the ability to do that. So if BBox, for example, at some point would say, well, we want to be more in control of our hedging strategy, then that could probably be organized via MFX, for example. So smaller companies know once it becomes more sophisticated, it also makes more sense for the company to have a direct relationship. And then it can be somehow put together.
Okay, clear. And then there was the one slide that you went quite detailed into one example. And Ajodeji has a question in regards to this. He asks, how does the borrower pay the $5,000 if he only has his money in local currency, and who pays for the US dollars equipment?
Well, so paying for the equipment is done because the whole idea of that loan, it's synthetic. So yes, it creates a local currency liability. The exchange rate risk is with the lender, not with the borrower. But the lender will still disburse in dollars. So if the off-grid company that's taking out that loan needs dollars to make equipment purchases abroad, then conveniently enough, the lender is actually disbursing in dollars. So that problem is solved at the disbursement phase of the loan, because you actually receive dollars. On the way back, and in the example, we assume that the currency depreciated by 100%, so that the initial disbursement was $1 million. Now the loan has to be repaid only $500,000. You're right, the borrower still needs to have that $500,000 in dollars to send to the lender. The way to do it is that if this is a company which is generating shillings or CD or whatever, in these countries there are functioning, especially in the shilling countries and in the Sadie countries and in the Kwacha countries, there are functioning spot markets. So if you are a shilling-based off-grid company generating shilling currency on your portfolio of receivables, you can go to a local bank and purchase that $500,000 from the bank. So there is a spot market, of course, with bid-ask spreads, and it's not perfect. There's also some liquidity risk. If there's tightness in the spot market, then you may be paying a higher spread. So it's not perfect, but as in other markets, there is a spot market, and you could just buy the currency that you need to make certain payments. In this case, the payment of on the loan in dollars.
Okay, thanks. I'll move to a question for Greta for a bit. It's a question from Nicolas Andribet. Greta, your loan is in US dollars, but you receive payment in US dollars as well, or, and this is about the DRC example, or do you get payment in Congolese francs? Greta, are you still online?
Yes, I am here. So basically, with the decision that was made when we launched our operations in the DRC was to take USD payments only. So that is what we are doing going forward. Whether that changes in the future, we're not sure. But our operations there are only 6 to 12 months old, so they're quite new. And at the moment, there's a strong feeling that USD is the way to go in that market. But obviously, as the market develops, and as many people know, it's a huge opportunity. It's a very big market, a challenging one, but a big market. In different areas, there may be the opportunity to take Congolese franc payments, but at the moment, we're just taking USD payments.
All right, thanks for sharing. So I have another 3 minutes, and then I'll stop this webinar. Avi, I have let's see, I have a few more questions for you. Can you describe the specific risks around non-deliverability of swaps, which is one of the last points on one of your slides?
Sure. So specifically with the non-deliverable swaps, I think from SunFunder's perspective, and therefore I think from any investor and potentially from the borrower perspective, there's two key pieces with the non-deliverable swaps. One of them just in general, because it's coming back in dollars and everything's being converted, being paid in dollars. So the local currency component is more of a sort of virtual layer on top of the underlying US dollar loan in our case. Convertibility is something that must be considered as a risk to be understood, and if it is a real concern, then there are also additional solutions to possibly mitigate that and other insurance products available on the market. The other piece on the non-deliverable, and I think this would go for any hedge, is the timing. So for example, if we were to do a complete fully hedged swap, say we're lending to BBox in Rwanda in this example. So they're similar to, I think, the structure that may be there with Deutsche Bank, is there will be a set schedule for repayments. There will be days that, when the interest payment on the loan are due. There are going to be set days when principal repayments on the loan are due. Generally in the sector, they're somewhat aligned, but be that as it may, whatever those dates are, they're known through the underlying loan agreement and defined there as when payments are due. On those days, if there's a hedge in place, BBox, having taken, say through MFX or working with TCX this loan, they're told, on this day, you are going to convert from Rwandan francs at this exchange rate to the dollar, and that's going to be essentially define how many dollars they owe through this arrangement to the hedging partner back to the lender, and then the lender, who's the one who's actually taken out the hedge, will settle out if it's high or low with the hedging partner. Now, say there's some administrative hang-up, wiring issue, anything. So BBox has sourced the dollars, but for whatever reason in this situation, the payment has come in late. The hedging agreement, which exists in parallel to but separate from the loan agreement, says that there's a settlement date and a payment is due. So there is that issue that if there's, regardless of what's happening with the underlying loan, the lender does have to settle things with the hedging partner and is on the hook for that exchange. The second piece is, say for whatever reason, the loan schedule changes. Maybe there's a restructure for good reasons, bad reasons. Maybe there's a decision for corporate reasons by the borrower to pay the loan down early. If there's a hedge, like I said, that has a set series of swaps, essentially, set days aligned to the loan agreement's payment dates on when US dollars and local currency are being exchanged. Even virtually, but there's a settlement that's expected to happen on those dates. So if you break the hedge early for whatever reason, there's costs that may be associated with that, and that needs to be understood. And who bears those costs has to be negotiated between the parties, typically between the lender and the borrower, so it's understood if the lender has to break the hedge early for whatever reason, who's going to bear that cost, or will they be reimbursed for that cost?
All right, thanks. Yeah, and I think with that we're really maxing out on our time here. I would like to thank all our panelists. I'm quite amazed that everyone made it, and we had the chance to give everyone the stage. TCX will be at the Unlocking Solar Capital Conference, and local currency topic will definitely be one of the topics that we'll be dealing with. If you're interested in the conference and you want to know more, or if you have any questions, don't hesitate to be in touch with me or one of my Solarplaza colleagues. Have a look on the website, and I do hope to see you all at this event. Greta, Avi, and Per, once more, thank you very much for being here and sharing your views and your experience with our audience. Yeah, and with that, I'd like to end the session. Thank
you very much.
Bye.